Okay, Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. And very good afternoon, everyone. So welcome back to our financial management class. And today we're going to discuss the stock valuation, the lecture 7, right? So before we continue to discuss our lecture 7, let me summarize a bit on what we have discussed last week on the lecture 6, which is the interest rate and bond valuation. So as you all remember, so during that lecture 6, I mentioned that uh, the first 5 lecture was about like provide you with the fundamentals and basic of the financial management. So we start with the introduction and then how to analyze the financial statement and followed by cash flow and financial planning. And then we learn the concept of time value of money. So after that, we need to apply all that knowledge and understand the financing decision and investment decision made by the financial manager. So we started with the bond valuation. So to value the long-term liability of a company, which is represented by bond, right? So since bond is very much related to interest rate, so the first part of the discussion last week was on the interest rate. We talked about the interest rate fundamental, which is when you invest in the debt securities, so you expect to get interest as a return from your investment, different than equity. So you just expect to get required return compared to the interest rate. And remember, we talked about the rate given to you is a nominal rate that consists of the real rate of interest, inflation, and risk premium. So the real rate of interest and inflation is actually the risk-free rate. So if you invest in the investment that higher risk than the risk-free rate, you can expect to get the risk premium as a compensation for the extra risk you take on the investment. That also we discussed last week. And after that, we talk about the term structure of interest rate and theories. So we first discuss the different type of yield curve. Under normal circumstances or the normal yield curve, the curve should be upward sloping. What's mean by upward sloping? Mean the short-term bond or the short-term debt instrument should have lower rate than the long-term debt instrument. Why? Because the short-term one has better liquidity, so therefore the risk premium is lower and the rate is also lower. However, in other circumstances where the yield curve, the historical yield curve show a downward sloping as well as the flat yield curve, then come many different theory to explain the behavior of the interest rate. So we talk about the expectation theory, mean the interest rate in the future will be determined by the expectation of the investors. Liquidity preference theory, I mean the short term one should always lower than the long term one because the short term one is more liquid than the long term investment. And the last one, market segmentation theory, high and low of the rates for short term and long term will be determined by the demand and supply. If more people demand the short term will be more expensive. If more people demand the long term will be more expensive. So they are all depend on the demand and supply. So those are the theories that we learned last week. So that's the first part about the interest rate. The second part of the discussion last week was on the corporate bond and how do we value the corporate bond. So we start with the background of the corporate bond. We understand that bond is between the issuer and the investors, so they need to be protected, so they have to have a legal document. And after that, we talk about cost of issuing, and then we need the investment bank to underwrite the bond issuing. And then we talk about convertible bond, conversion features, and callable bond. And we also talk about different type of yield, yield to call, current yield, and yield to maturity. And finally, we talk about bond prices, which is further elaborated in the bond valuation. So in bond valuation, we apply the knowledge of the time of value of money in valuing the bond. Because since we want to know the value of the bond today, so we need to use the present value concept. So remember, bond has two parts in terms of the cash flow. The future cash flow, the first part is the coupon interest. The second one is the par value that you are going to receive in the future. So what you have to do, you have to discount all of them back to time zero. So by using the present value of the annuity as well as the present value of a single amount, right? So that's how we value the bond. So remember, bond can be sold at discount, par or premium. It depends on the relationship between the coupon interest and the interest rate or the required return, right? And finally, we talk about how to actually calculate the yield or the return of the bond if you hold the bond until maturity. So that's basically the topics that we have discussed last week. Yeah. So before we continue, any question from anyone? Yeah. So no question, let's continue. So we'll discuss further during the tutorial this week on the bond valuation. So as I mentioned last week, we talked about how to value the bond. So it's part of the long-term liability financing decision. And today we're going to continue how to value the stock valuation. So now we want to decide on the financing decision where the company want to raise the equity and how do we value the equity. That we're going to discuss today, right? Yeah. And then from next week onward, Dr. Fauzi will take over and Dr. Fauzi will continue with the risk and return, with the cost of capital, capital budgeting technique, cash flow in the capital budgeting, current asset and current liability management. And today, these are the topics that we want to discuss. First, we want to discuss the difference between debt and equity. And after that, we're going to talk about common stock. So common stock or ordinary shares, they are the same thing, right? Common stock is the US term. Ordinary shares is the UK term. In Malaysia, we use the ordinary shares. The third one, the preferred stock or preference shares. They are the same. Preferred stock, the US term, UK term, they use preference shares. In Malaysia, we use preference shares. What is a venture capital? And when the company want to go public, how actually the process? And finally, how do we value the stock? What are the models that we can use to value the stock? Yeah. You see that we have many different models that we can value the stock, unlike bond, which is very straightforward. Yeah. So the first, second, third, fourth, and fifth one, I think I'm going to go through very fast. I'm going to focus on the last one. But if you don't understand or you want to get more explanation, please let me know, right? Because I can always stop and repeat my explanation. Yeah. So please ask. Don't just actually let me continue without you understand, and after that you will complain. Yeah. So the lecture is very fast, so I couldn't follow. So yeah, now I let you actually ask question, or I mean you can stop me if you actually want to get more explanation. So the learning goals is the same thing, right? Okay, we're going to start with the differences between debt and equity. So I think we all know what is the debt, what's its equity. We have discussed this much earlier. Debt includes all borrowing incurred by a firm, including bond, and is repaid according to a fixed schedule of payment. Equity consists of funds provided by the firm's owner, the investors or the stockholders that are repaid subject to the firm performance, mean the dividend. Debt financing is obtained from creditors and equity financing is obtained from investors who then become part of the owner of the company. Creditors have a legal right to be repaid, whereas investors only have an expectation of being repaid. Yeah, it's like when you want to start a business, debt if you borrow money from someone, equity is you use your own money, right? So when you borrow money, of course, that person who lend you money have a legal right to be repaid. However, for yourself, so you can just expect to get a certain amount of return, but it's not guaranteed, right? It depends on the company performance. So it's like that. So that means whoever invests the money as a shareholders or shares, so they cannot actually they cannot guarantee any return on the investment. Sometimes can be high, sometimes can be low, depend on the performance. So I just want to focus on the key differences between debt and equity capital based on this particular table, and the rest you can read by yourself. The first one, the characteristic of the debt and equity from the voice in management perspective. Yeah. So I think we all know, as a debt holders, if you invest in debt, you cannot vote in the AGM, or you have no voice in management. Different than equity, if you invest and you become the shareholders or the owner of the company, you have voting right, and you have right to choose the board of director, and as well as to appoint the CEO of the company, so the management. So it means you have voice in the management. That's very obvious. The second one, claim on income and asset. Yeah. So debt is senior to equity. What does that mean? So mean whenever you get any earning before interest and tax, you have to pay interest first. So you pay tax, only then you can pay dividend to the shareholders. You cannot pay dividend before you pay interest. You cannot say that, okay, I give dividend to shareholders, but when it comes to paying the debt, so I hope no money to pay the debt. No, you cannot do that. Yeah. If no money to pay the debt, that means no money to pay the shareholders. So the claim on income and asset on debt is senior to equity. Similarly, when company fall into bankruptcy, you have to settle the debt first. Yeah. As an example I give you just now, in our business, if we suffer losses or we fall into bankruptcy, whatever asset that we have to pay the debt first. Yeah. So therefore, the equity is subordinate to debt. Yeah. So after you settle your debt, only then the leftover you can give to the equity holders or the shareholders. That's claim on income and asset. Maturity, as we discussed last week, bond has maturity date, where you know when you're going to get back your principal or par value. However, equity investment has no maturity date. Once you purchase the stock, you cannot expect to get back your money. If you want cash or you need liquidity or the money back, you can sell to the third party. Yeah. Unless that the company want to buy back the share from you. So that's not up to you, but up to the company. That's a maturity. Stated for debt equity, no maturity is stated. And the last one is a tax treatment. Yeah. For the debt holders, there is an interest deduction, and equity holders, no deduction. What's mean by this? Remember, in the income statement, when you pay interest before you pay debt. The more interest you pay, before you pay tax. Yeah. So the more interest you pay, the lower the tax that you have to pay to the government. Because when you pay more interest, your profit before tax will become lower. So lower tax. However, when you pay dividend to the shareholders or equity holders, you pay the dividend after you pay tax. So there's no benefit or no changes of the tax payment when you pay dividend. So that's meant by for tax treatment, that is interest deduction and no deduction for the tax when you pay the dividend. Yeah. Okay. So the notes there, debt holders do not have voting right, but instead they rely on the firm contractual obligation to them to be their voice. Yeah. Okay, for this, any question?
Very clear, Doctor.
Okay, thank you. So this you can read by yourself lah. I mean the details of what I just explained to you. Yeah. So I just want to highlight to you on this example, right? Yeah. Between the two companies. We have two companies, A and B. Both of them has the same amount of earning before interest and tax, which is 100 million. Company A has no equity, only debt. So the company A decided to pay 3 million interest to the company B. And company B has no debt, right? So only equity holders or shareholders. But the company B also decided to pay 3 million to the shareholders. Company A decided to pay 3 million to the bondholders. Company B decided to pay 3 million to the shareholders. Both of them will pay 3 million. One to the bondholders, one to the shareholders. You see what will be the effect? Because you pay interest before you pay tax. So both company has tax 38%. However, because of the earning before tax for company B is higher, the company B need to pay higher tax by 1.14 million. So look at that. If the company B pay 3 million to shareholders, company A also pay 3 million to the bondholders. Look at the retained earning. The retained earning of company A is higher by 1.14 million. So that's the benefit of actually taking debt, because you pay lower tax. But it's not all good, right? Because when you pay interest, your risk is high. Just imagine when your EBIT is 1 million only instead of 100 million. So you still have to pay 3 million interest. Different than company B. If the earning is only 1 million, they can just pay less dividend, or they don't have to pay dividend at all to the shareholders. So less risky for the company B, higher risk for the company A because of taking debt as compared to B only equity. So these two are the extreme example. So we just want to show you that when you take debt, when you pay interest, you tend to pay lower tax. Yeah. Okay, any question?
Doctor, can I confirm again with you? The bond is related to debt and the interest, and then the share is related to the equity and the dividend. Am I right?
Yes, strong reason.
Okay, doctor. Thank you, doctor.
Thank you for your question. Any other question? Everyone okay? Is this?
Doctor.
Ikmal.
Can doctor go to the previous slide? The difference. I mean,
What is your question?
the calculation. No, I just want. to finish to write it.
Oh, so if you use a laptop or computer, alternatively, what you can do, you print screen, right? Yeah.
Yes.
So, okay, Ikmal, done.
Okay.
Okay, any other question? Okay, this is the one that we just discussed, the difference between debt and equity. And then we're gonna start with the common stock or ordinary share. Common stock or ordinary shareholders, who are sometimes referred to as a residual owner or residual claimant, are the true owner of the company. What's mean residual owners? Because the common stockholders receive what is left, which is the residual, after all other claims on the firm income and asset have been satisfied. They are assured only one thing, which is they cannot lose more than what they have invested because of the limited liability. This we have discussed in the very first lecture. Because of this uncertain position, common stockholders expect to be compensated with adequate dividend and ultimate capital gain. So, they're not guaranteed any return, right? As a common stockholders. Yeah. But it's guaranteed only they actually cannot lose more than what they have invested. So if they invested 50,000, that's the most they can lose. But they're not guaranteed any return. So they're quite uncertain. So because of that, they're actually required to get higher return as well as to receive dividend from the company. So the common stock of a firm can be privately owned, closely owned, or publicly owned. So by the name itself, so privately owned, you can know that, so it's just privately between the family, right? Yeah. Or closely owned between small group of investors, or they are open to public. And the share of privately owned firm, which are typically small corporations, are generally not traded. If the shares are traded, the transactions are among private investors and often require the firm consent. However, large corporations are publicly owned and their shares are generally actively traded in the broker and dealer market or the stock exchange. So what you need to know for the shareholders or the common stock or the ordinary shares, first the term par value. The par value of common stock is an arbitrary value established for legal purpose in the firm corporate charter and can be used to find the total number of shares outstanding by dividing it into the book value of the common stock. When a firm sells new shares of common stock, the par value of the shares sold is recorded in the capital section of the balance sheet as part of the common stock. At any time, the total number of shares of common stock outstanding can be found by dividing the book value of common stock by the par value. We'll see that later. However, what you need to know, the par value of common stock is an arbitrary. It's not like bond, which is the par value is very important because that is the value that you will receive on the maturity, and that is the value that people will use to calculate the coupon interest. However, since the dividend is not based on the par value, so par value is just any number. It's just to fulfill the requirement of the corporate charter. So it can be any number. The second one is the preemptive right. Yeah, preemptive right actually is allow common stockholder to maintain their proportionate ownership in the corporation when new shares are issued, and this allow existing shareholders to maintain voting control and protect against the dilution of their ownership. In a right offering, the firm grant right to existing shareholders which permit them to purchase additional shares normally at a price below the current price. So it is like this when you actually own a company. So I have an example here. Just look at the first table between investor A and investor B. So we assume that the company only have 200,000 shares, and then A own 50% ownership, B own 50% ownership. If, for example, the company want to issue more shares, another 100,000, the company will give right to investor A and B first to purchase based on their ownership. If the company want to issue 100,000, the company will offer 50,000 share to A and 50,000 share to B, to buy the new share. So normally, the company will actually give special price to A and B. They don't charge at the full price. And they give another one, they call it right to buy at this price. Just imagine if the company issue another 100,000 shares to C without informing A and B, what will happen? You see the ownership of A and B drop from 50% to 33.33%. But the shares remain the same, right? 100,000, 100,000. It's just because the company introduced new issuance and they introduced to C. So to compensate the investor A and B, so they have to first issue to A and B. If A and B refuse, A and B can actually sell the right to the third party. Okay, just take an example. If the share value is 5,000 per share, but the company give right to buy at 4 ringgit. The company want to issue a new shares that value 5 ringgit per share. So for A to maintain the ownership of 50%, A need to buy another 50,000 shares. Sometimes A may have no money to buy. But the company offer A that if you want to buy, you can buy at 4 ringgit only. Instead of paying me 250,000, you just pay me for 200,000. For $4 or 4 ringgit multiplied with 50,000. Similarly, the company offered to B. Yeah. So if A and B refuse to buy or to give another 200,000 in order to maintain the ownership, A and B can actually sell the right, yeah, to buy at 4 ringgit. Yeah. Right is like a coupon. Yeah. Like someone give you the coupon, right? Okay. With this coupon, you can buy the 5 ringgit share at 4 ringgit, for example. And you have 50,000 coupon to buy at 4 ringgit. Yeah. So what you can do, if you don't want to use that coupon, you can sell that coupon to the third party. You can sell at 1 ringgit. Because if whoever buy that coupon 1 ringgit, they can buy the stock at 4 ringgit. So still they pay 5 ringgit. Or you can sell the coupon at 80 cents, for example, right? Yeah. So if 80 cents, you probably can get 40,000 ringgit, yeah, from the 50,000 coupon that you have, or right. Yeah, that we call as a right issue. If you don't want to maintain your ownership, you can sell the right. You get some money. However, your ownership will change, will drop. I mean, from 50% to 33%. That we call as a preemptive right or right issue. If the company decide to issue any new shares, they have to first issue to the existing shareholders. They give them right to buy the stock first. That basically the right issue. Okay, any question on this preemptive right or right issue? This is traded. The right issue is traded in the stock exchange.
Doctor, like in this case, or how roughly how much they can sell the right?
Yeah, depend on the demand. So if many people want to buy, they can sell to the maximum lah, 1 ringgit, right? Yeah. If not many people want to buy, they have to actually sell at discount. Yeah, because normally it's not that expensive lah, up until 1 ringgit, probably a few cents only, right? The in reality, just give example lah to simplify. So you may sell at a discount. Yeah. So if the investor feels that okay, the right value is 1 ringgit, and if the investors A sell to me 80 cents, so I benefit, right? Yeah, 20 cents per right. Yeah.
Thank you, Doctor.
No problem. Thank you for your question. Any other question? Okay, if no question, let's continue. So the third one, first you have to know what is a par value, and then we have to know what is the preemptive right or right issue. Now you have to know the difference between authorized shares, outstanding shares, treasury stock, and issued shares. Right? So authorized shares is the maximum number of shares that you can issue. This is the authority given to you. So when you want to become public company and you want to issue new shares, you get permission from the regulators, normally the Security Commission. So in this case, we take the example that the maximum the company can issue is 35 million number of shares. So if you get permission to issue 35 million, you normally don't issue to the maximum, right? For example, like in this case, the company issued only 15 million, or we call it as a issued shares. The first time when the company issued 15 million, the outstanding shares is also 15 million. So at that time, issued shares and outstanding shares are the same. However, when the company decide, for example, like in this case, to buy back the shares from the market, from the public, from 15 million, the company used the money to buy back from the market at 1 million. So what left or available that traded in the market is 14 million. And then the one that the company purchased, we call it as a treasury stock. So the issued shares will equal to outstanding shares and treasury stock. Okay. Any question for this?
No question, Doctor.
Okay, let's continue. You see the example. Thank you, Iqbal. So this is from the balance sheet, right? Oh no, the stakeholders equity report lah. Part of the balance sheet to report the total stockholder equity is 102 million, right? So in this case, the company can issue up to 35 million shares, but the company only issued 15 million. And the par value is 80 cents per share, right? Yeah. So it's not when the company issue shares, the price is 80 cents. That is the par value. But the remaining is a paid-in capital in excess of par. Yeah. And then the company has purchased back 1 million shares and cost of treasury stock. So in this case, authorized share is 35 million, the issued share is 15 million, treasury stock is 1 million, the outstanding stock is 14 million. Sorry. Look at this example. The value of the common stock is 12 million. 80 cents per share, right? The par value. So when we take the book value divided by the par value, you get the total number of the shares issued, right? So this is what we have discussed on the par value just now. In this case, the company actually sell the share with the value of $5. And the company decided to take 80 cents as the par value, and then the remaining $4.20 is a paid-in capital in excess of par. Yeah. So in this case, 80 cents multiplied with 15 million, you get 12 million. And then 15 million times $4.20, you get 63 million. And then not only the shares, but the shareholders also have the retained earning. So it will be accumulated every year. So here is 31 million. So and after that, the company used the equity to actually buy back the share from the market, where the value is 4 million. You see, they sell at $5, but they buy back at $4. Yeah. Normally, the company will buy back the shares when they feel that the stock is undervalued, right? So then, the total stockholders' equity is 102 million. So this is basically the concept of the common stock or the equity holders report. Yeah. Okay, any question for this? Very quiet during Ramadan. So probably everyone is tired.
Sorry, Doctor. How do the 63 million obtain just now?
The 63 million?
Yeah, the
from this one, right? Is it 63 million? Can you say that, see the paid-in capital in excess of 63 million?
Oh, okay.
So as I mentioned, the actual price is actually $5. The company decided to take 80 cents as a par value, and the remaining $4.20 will be paid in capital in excess of par. If the company use $1 par value, paid in capital in excess of par will be $1. Sorry, not $1, $4. Sorry.
Sorry, Doctor.
Okay.
My question is, sorry, if you could go back to the
this one.
Yeah, the equity. Yeah, the value for 63 million paid in capital in excess of par. For example, in the question, will that amount is given, or we need to calculate that ourselves?
It depends, Rafi. If, for example, like if I told you that, okay, the share price is $5 and the company issue 15 million, and then the par value is 80 cents, right? So you can calculate by yourself. No? And sometimes it can also be given to you, so you don't have to calculate. But what we need you to know is to understand the concept of the share price, and then the par value, and then the paid-in capital in excess of par. So that means share price when the first issue consists of two items or two parts. So the first part is the par value, the second one is the paid-in capital in excess of par. So if you know the total number of shares issued, and then the price, and then the par value, so you can always calculate the paid-in capital in excess of par. So is it okay, Rafi?
Yeah, very
Okay.
clear. Thank you.
No problem. Thank you for your question. Any other question? If no question, let's continue. So voting right, yeah, as you know, if the shareholders, you have for one share normally one voting right in the election. Yeah. So since that, I mean, there are many shareholders, not all of them will come to the AGM, so they will appoint a proxy, right? If you have very little amount of shares, normally you will appoint proxy to represent you, yeah, in the AGM. Then they will choose who will be the board of director, and then the board of director will decide on the management. That's the voting right. So the dividend, the payment of dividend to the firm shareholder is at the discretion of the company board of director. Dividend may be paid in cash, stock, or merchandise, and common stockholders are not promised any dividend because they are the residual claimant. The company have to settle all the interest, debt, and everything first before they can give dividend to the shareholders. Yeah. And then now people are exposed to international stock issuance, right? You in Malaysia, but you can always invest in the foreign market, like in the US. So the most popular one is the ADR, American Depository Receipt. It's something like normally the US banks, they have the investment called as a ADR, where you can give your money or buy the ADR, where you get exposure of the US firms by actually investing in this ADR. You have to invest in the US dollar. So since actually the investment in currency other than the local currency, so on top of the risk of the company itself, so you are also facing with the currency risk, right? Yeah. So that is the ADR. It's not only everywhere in the world, most of the countries now, I mean the investors can invest in the ADR. So at the moment, it's not only ADR, there's also any other global depository receipts, right, from other markets with different currency. Yeah. So that's the common stock. Yeah. Now we want to go to preferred stock or preference shares. Yeah. Preferred stock is an equity instrument that usually pay a fixed dividend and has a prior claim on the firm earning an asset in case of liquidation. The dividend is expressed as either a dollar amount or as a percentage of its par value. Therefore, unlike common stock, a preferred stock par value may have real significance. If a firm fails to pay a preferred stock dividend, the dividend is said to be arrears, outstanding, or owed. So the simple term preferred stock or preference share is a hybrid securities. Hybrid means it's a mix between debt and equity. Preferred stock has debt feature and also equity feature. What is a debt feature? Because the preferred stockholders receive fixed dividend. It's like coupon interest. What is the equity features? It has no maturity, and then it is part of the equity. So that means any dividend paid through the preferred stock will not get the tax benefit. Yeah. However, preferred stockholders has no voting right. It's not like common stock. Yeah. And it's also less risky for the company because for the debt, remember, By hook or by crook, you have to pay the interest regardless of your performance. But for preferred stock, normally you can actually accumulate. If, for example, like this particular year, you're not doing well, so you're supposed to pay preferred stock dividend, but you can hold. You can accumulate the dividend for the next following year until you get profit and pay the preferred stock holders the dividend. So it's less risky. Yeah. So this is already explained, and it called as a fixed income securities where the dividend never change, and it also has like bond call features. Yeah, the company can sometimes retire the preferred stock, although it has no maturity, but they give right to the company to actually call the preferred stock with any time. Yeah. Since the company normally have planned to retire the preferred stock, they also have a mandatory sinking fund. In case that they want to buy the preferred stock from the investors, they need to have a huge capital to pay the preferred stockholders. So alternatively, they may give the conversion features right to the preferred stockholders where they can convert the preferred stock to common stock after a certain period. Yeah, that's a conversion features. So that's a preferred stock. Yeah. We're going to talk about venture capital, and after that we take 5-minute break and we're going to discuss the going public stock valuation. So venture capital, I think you all know and you heard about the venture capital. When the company want to issue the stock, right? Yeah. Because they need capital. When they find the opportunity but they don't have enough money, they may actually invite other people to also become the investors for the company as a shareholders, right? But before they go public, normally it's hard to convince the investors because there's no history of the company performance, especially for a new company, a startup company. So therefore, they need to get the venture capitalists to invest. What is the venture capital? Venture capital is a privately raised external equity capital used to fund early stage firm with attractive growth prospect. Means someone who willing to take high risk, right? The venture capitalists. Or sometimes they call it angel capitalists. Wealthy individuals who have money and then want to help the early stage firm or the startup company. Yeah. Because normally the normal people, they are not willing to take very high risks, especially for an early stage firm or a startup company. So therefore, only those who are actually willing to take risk can invest. So this group of people, we call them as the venture capitalists. So the venture capitalists can be either small business investment company, financial venture capital, corporate venture capitalists, and then venture capitalist limited partnership. Yeah. So I mean there are many different type of venture capitalists. That someone who just want to have a startup business, they can approach, but they have to bear in mind that you have to share a huge profit with them, right? Yeah. So these are the responsibility and interests of the both parties, right? The entrepreneurs and the one who provide the capital, right? So there are terms and conditions. Remember, of course, this venture capital investment will be protected by the regulation. The Security Commission is governing the venture capital investment, right? So because of the risk, they always have the exit strategy. If they feel that the business is not going well to that extent, they have to exit early to not suffer losses more. So that is the venture capital. Yeah. So any questions so far? Before we take a 5-minute break. Yeah. So we continue at 3:52 for me to discuss on the going public and stock valuation. So we have discussed on the difference between debt and equity, and then what is the common stock or ordinary shares, what are the characteristics, the par value, the right issue, the ownership, what's the difference between authorized shares, issued shares, and outstanding shares and treasury stock. And after that, we talk about the hybrid security, the preferred stock. where it has debt feature and also the equity feature. However, no voting right for preferred stockholders. And then for the venture capital, it's normally for a startup company, they need capital and they need to find someone who willing to take the risk. Yeah, only then they can invest. Yeah. Okay, that's a venture capital. So we'll take a break and then we continue. And now it's 3:48. Yeah. Let's continue at 3:55. Yeah.
Okay,
So
doctor.
okay, thank you. There's a question, Doctor, just a quick question. What are the topic covered for our midterm exam? Yeah, next week is your midterm test, right, on Friday. I just want, I will let you know probably by end of this week. No? So the topic from lecture 1 until lecture 5. Yeah. Okay, Sita. Oh, how venture capitalists make money? Yeah, if for example, like you invest in the startup, right? They need 20,000 ringgit. So you invest in 20,000 ringgit. Probably after 3 months, the value of the company increase. To says like 30,000, right? Then you share between you and the entrepreneurs. So that's how they make money. It's kind of like you're willing to take a high risk investment. Yeah. It's like Facebook, right? Yeah. When they start, that actually started with the venture capitalists. Yeah. That's why the founder left the Harvard University, because you see, sitting at the Harvard University is less valuable for him than continue with the investment in the venture capital in the Facebook, which is worth, right? Yeah. It's worth it to left the top university and invest. Yeah. So that's basically how they make money, because they know that they grow. Yeah, because normally when we put the money in the bank, so we can only get, say, it's like, I think 2%. Yeah. But here, if the investment promise like 30-40% a year, right? So definitely they want to take that opportunity. But the risk is also very high. Probably from 10 investment, only 3 are successful. So the rest are lost, right? So I think, so you also have to be very careful. Yeah. So the Facebook is one of the successful example from the Mark Zuckerberg, right? But we don't know, right? Probably 100 or 1,000 of the company like Facebook fail to be as successful as Facebook. Yeah. So risk is very high. Okay, Zulaika? Yeah, sorry. Izati, yeah. What time is our test next week? 3 o'clock. Yeah. I already sent you email, right? Last week. 3 p.m. Yeah. Okay, any question you can just share at the chatting box. We take a 5-minute break and we continue after this. 3:55. So, Doctor, what format will be the test like? So I'm gonna give you the detail by end of this week or next week. Yeah, I mean the question will be MCQ. I mean from the what lecture 1 until lecture 5. Yeah. And then the second question, Doctor, can you explain again on the treasury shares? Yeah, treasury shares. What you have to understand, treasury shares like this. Let me go back to the treasury shares or treasury stock, right? It's treasury stock. Issued shares or common stock by the firm of these shares have been repurchased by the firm. So, like this, the company issue 15 million share, right? Okay, we just imagine that 15 million share equal to 15 million shareholders. Yeah. Then the 15 million shareholders are actually many lah, a lot. Yeah. And then the company want to reduce the number of shareholders in the company. So what the company can do? The company can buy back the share from the investors. So that means the company use, like in this case, the company pay 4 ringgit per share. And then the company purchase 4 million, 1 million shares, right? So the company have to spend 4 million. So they will give 4 ringgit per 1 shares. So from 15 million, now the company just need to share with 14 million shareholders only. Because remember, when you have profit, you want to share with less people. You should not share with more people. Yeah, this is the normal understanding, right? Yeah, the capitalist thinking. This is from the corporation perspective. Yeah. So if you can share with less, why should we share with more, right? So then when the company thinks that it's good or they feel that the stock is undervalued, they will buy back from the shareholders. So they will give them money. They will actually reduce the number of the shares. Yeah. So that's mean by that will be recorded as a treasury stock because you pay this money 4 million to the shareholders and the shareholders give up their shares. Yeah. From the 15 million shares you issued, now only 14 million in the market. 1 million you already buy back from the shareholders. If you decide to buy all of them, 15 million from the market, right? So mean the company become private. Yeah, no more stock that are traded in the market. Like one time Maxis purchased back all the shares from the market and it become private company, right? For a few years. Yeah. So why don't they just issue 14 million? At first, when the first issue, yeah, they need remember 15 million times 5, right? Yeah, I'm not very good in the calculation. 15 million times $5. So they need 75 million ringgit or dollars. Yeah. So if they issue only 14 million, they cannot get the capital that they want. Yeah. So it's not happen immediately, right? You buy back, you sell and you buy back. No, probably after 3-4 years, so you are successful and you get more capital. But you don't know where to use that capital. What you can do, you reduce the number of the shareholders. Yeah. So then you use the equity, the money that you have, and then you buy back from the shareholders. When the first issue, they need the 15 million. But later on, after they continue the business, they feel that 15 million are just too many. So why not we reduce to 14 million only? So since we have money, so we buy back the shares from the market. Yeah. Is it okay? Nazurin and Alia? Okay. Any other question?
Doctor.
Yes.
If the firm repurchase back the shares, is it going to increase the treasury shares or the issued shares?
Issued share will remain the same. Like in this case, right? Outstanding share will drop, and then treasury stock will increase.
Oh, okay. Thank you, Doctor.
No problem. But treasury stock will be, you have to minus lah, because you use the money to pay the shareholders, and then you reduce your shares. Yeah. This is the cash outflow, right? When you repurchase the stock. You give dividend, you repurchase the stock. So it is another way that you give the money to the shareholders. Yeah. Okay, thank you, Ikmal, for your question. Any other question? So this is also, we finish venture capital. Now we want to go public, right? Yeah. So we just want to know the terms that people use when the company want to go public. So when the firm wish to sell its stock at the primary market, it has three alternatives. Primary market means you issue shares, you get money. Yeah. But remember, when you trade the stock at the stock exchange, that we call as a secondary market, if it is not public offering, initial public offering, right? Yeah. So the company did not receive the money. It's just between the investors, between the shareholders. You buy and sell, right? So the company will get the money when they first issue the security. Yeah. That we call as the primary market. So the company can actually issue the stock as a public offering, or right offering, or private placement. Public offering, you issue to the public give you money, and then you can use the money to make investment. Right offering, you issue to the existing shareholders give you money, and then you can continue use the money to make investment. Private placement, you don't offer to public or existing shareholders, you just approach a certain group of individuals or companies, right? Then they invest directly to you. That we call as a private placement. But here we want to actually expose you to just on the initial public offering. Later when you take the capital market or the what we call the portfolio investment, you can know further about this public offering. So this is just a basic concept of the initial public offering, IPO. When the company issue the security, company get the capital. Yeah. You see, that is the purpose of the debt issuance and the stock issuance, right? Because to give money to the company to actually make investment. Yeah. We call it as a financing decision. However, in reality, right, the transaction in the market, I think less than 1% is for this primary market. Yeah. Mainly on the secondary market, it's just for speculation, right? It is not give any much value to the real economy. Yeah. Because when you give money to the company use the capital and generate economy, right? So if you just actually exchange the stock between one hand to another, go up and down, right? Yeah, I think they don't create any economic value, which is not very good, right? From the economic perspective, it just benefit the speculators. Yeah, so they make I think what I call the fake news or fake story, and then you start to trade, and then after that they buy back. Yeah, it's kind of like the fake news lah, mean to benefit from the secondary market. So that's the reality, which is more than 99% the transaction on this for speculation, not to help the real economy. Yeah. So we believe that all this debt, equity issuance mainly for the real economy, but sadly only 1% of them this is for the real economy. The rest are just for the speculators. Yeah. Which is not helpful to the economics at all. Yeah. And then the IPO, right, are typically made by small, fast-growing company that either require additional capital to continue expanding, or have made a milestone for going public that was established in the contract to obtain the venture capital funding. After the company a bit stable, still small, and then fast-growing, want more capital, they can be actually go public, get approval from the current shareholders, and then hire investment bank to underwrite the offering, and then this is the investment bank's role to promote and facilitate the issuance of the new shares. So first, the company must file the registration statement with the Security Commission, and after that, come out with the prospectus. Yeah, prospectus is the details of the key aspect of the issue, what you're going to use with the money the investors give you, and then who are the issuers and the management of the company, as well as the financial position of the company, to provide background to the investors, the potential investors who want to buy or invest in the company. So in the US, they call the red herring is the preliminary prospectus. Yeah. I mean, while waiting for the approval from the Security Commission, so you definitely need a preliminary prospectus. It's kind of like a brochure, right? Yeah. I mean, a summary of the prospectus to actually market your stock issuance. Yeah. So in the US, they use this red herring, so to differentiate between the full prospectus as well as the preliminary prospectus. Yeah. In Malaysia, I think we just call preliminary prospectus. I mean, it's kind of like a brochure to actually give some ideas about the company. Yeah. Normally now everything is online. You can access the company website or the bank website. Yeah. So that's the requirement. Register, meet the condition, and then have a prospectus and provide the brochure for the investors to know about what you're going to do with the money. Then hire the investment bank. Investment bankers and the company official promote the company through the roadshow, a series of presentations to potential investors around the country and sometimes overseas. And then they help the investment banker gauge the demand for the offering, which help them to set the initial offer price. After the underwriter set the term, the Security Commission normally approve the offering. So, I mean, you have to do the promotion too, right? In order to make that the stock is fully subscribed. Then you can raise the capital that you want. Yeah. So the investment bank rules. Yeah, this is the main rules of the investment bank is to underwrite. Yeah. Like underwrite bond, underwrite stock. Yeah. Most public offerings are made with the assistance of investment bankers because they are the expert in the stock issuance. Investment bankers are financial intermediaries that specialize in selling new securities and advising the firm with regard to major financial transactions. And the main activity of the investment bank is underwriting, which involves the purchase of the security issue from the issuing company at an agreed price and bear the risk of selling it to the public at a profit. Like this. When you want to sell something, the value is 5 ringgit, right? And then you don't have the expertise. So you sell your product to the supermarket, but you don't sell at 5 ringgit. Say like you sell at 4 ringgit and the supermarket buy all of them from you. Normally the supermarket don't do that lah. It's just an example. So supermarket just let you put your stuff and then you also take the risk. But in this case, the investment bank will take the risk. The investment bank will buy all your stock at a discount, and then the investment bank will sell the stock to the investors. And then the difference between the selling price and the price they pay to the company is the profit for the investment bank. So sometimes if you want to issue 15 million shares, so the originating investment bankers don't want to take 100% risk. If they couldn't sell the 15 million by themselves, so they may suffer losses because they already pay the company the money, right? Therefore, they will form the underwriting syndicate. They will invite other investment banks to help them to sell the stock. Yeah. So the next slide is an example on how the compensation of the investment bank and how the syndicate work, right? I mean, how the originating investment bank make profit by become the underwriter of the stock issuance. Yeah. So this you can see. Yeah. So if the stock value is $26 and the company, the investment bank paid $24 only to the company. So $2 is the profit if they manage to sell, right? But if they couldn't sell, so they don't want to take risks to sell all of them, so they will sell the stock to the other investment bank at $25.25. So $1.25 is the profit for the originating investment bank, and then 75 cents will be profit for the other investment bankers per share, right? Yeah. So that's basically how investment bank make money. Yeah. Okay, any question? No
question.
Okay, thank you. If no question, I think now we come to the stock valuation, the last part, right? Yeah. Common stockholders expect to be rewarded through periodic cash dividend and an increased share value. And some of these investors decide which stock to buy and sell based on the plan to maintain a broadly diversified portfolio. And other investors have more speculative motive for trading. So when you invest, normally you expect that the stock price will increase, or you want to get some dividend from the stock investment. And some others, they want to diversify the portfolio. They don't want to put everything in the saving account because the return is too low. So they mix some in bonds, some in stock, some in the saving account. And some others is what most people do. So it's a speculation. So to expect that the stock price will increase, or they sell and they expect the stock price will drop. So that's how the speculators work. Yeah. So in deciding on the stock price, we have to understand the concept of market efficiency. Economically, rational buyers and sellers use their assessment of an asset risk and return to determine the value. For example, like if you are rational, when you want to buy something, like in this case, when you want to buy stock, you try to balance between risk and return before you decide on how much the price you should take, right? If the risk is too high, you also have the aspect the return is also high. If the risk is high and return is low, you will decide not to invest in this particular stock. Or if the risk is low, return is high, then you will decide to invest. So that means the buyers and sellers are rational. In a competitive market, remember we have million of investors, right? The interaction of many buyers and sellers result in an equilibrium price. So the price of the stock will be decided on the value of the stock itself, because the value will be determined by the demand and supply, right? So for example, like if someone feel the stock is overpriced already, so they will stop buying or they will sell, and then they will lower the value. So because of the flow of new information is almost constant, stock price fluctuates continuously, moving forward to a new equilibrium that reflects the most recent information available. This general concept is known as market efficiency. And suddenly, the company make a very good initiative and very good investment decision. What do you think will happen? Many people will demand to buy the company stock because they know that the investment will be a good investment. So what will happen? When the demand of the stock increase, the stock price will increase. So at the new equilibrium. However, when they feel that, okay, the company appoint the corrupted board of director or the bad CEO, right? And then people think that in the future, the company has no future. So what they will do, they will decide to sell the stock. If many people start to sell the stock price will drop at the new equilibrium. So this is what we call the stock price should reflect the most recent information available. So that's the definition of the market efficiency. So when you buy the stock in the market, so that's the actual price. So you don't pay more than the value, and you don't pay less than the value. Yeah, so you pay at the right price. That market efficiency. So the efficient market hypothesis is a theory that describes the behavior with the assumption that the market is perfect. So the EMH, the efficient market hypothesis, say that the security that we buy and sell most of the time are at equilibrium. And then the prices will fully reflect all the available information and react swiftly to the new information. If there is any new information, immediately the stock price will be reflected. Yeah. And because stocks are fully and fairly priced, investors need not waste time looking for mispriced security. So you don't have to waste time to find, okay, I want to buy the underpriced stock and then sell the overvalued stock. So in the efficient market, so that will not happen, right? So this is the argument of EMH. So I think they introduced in, if I'm not mistaken, 1976, yeah, by Eugene Fama, professor at Chicago University. And he won the Nobel laureate in 2014, right? For this efficient market hypothesis. Yeah. So you don't actually use any techniques to invest in stock because that doesn't work. The stock price movement should be random. No one can actually expect the behavior of the stock, yeah, or estimate. Although considerable evidence support the concept of market efficiency, a growing body of academic evidence has begun to cast doubt on the validity of this notion. Although the founder has won the Nobel laureate, but there are many arguments say that the market is not efficient because of a growing body of research that focus on investor behavior and its impact on investment decision, and stock prices have proved otherwise. This another science or theory we call as a behavioral finance. Yeah. So who introduced this? Another professor from Chicago University, Professor Richard Thaler, right? Yeah. He introduced in 1990s, early 1990s, and he also won the Nobel laureate in 2016, 2 years after Eugene Fama. So I think, so both of the theory are recognized in the market. It can be efficient at one time, and then the behavior of the investors can also change the efficiency of the stock. Yeah. So that's basically the market efficiency. How do we price the stock? Yeah. Because today we want to talk about the stock valuation, right? Yeah. How do we decide on the stock price? Yeah. Like last week we talked about how do we decide on the bond value. Now we want to talk about how do we talk about the stock value. Yeah. Okay, any question before we start on the stock valuation part? So as you can see, there are many different models. Like last week, here again we will actually apply the concept of time value of money. Here we want to know the present value of what, right? Yeah. But last week we want to know the present value of the annuity plus the present value of single amount, and then we can actually know the value of a bond. Now, remember, when we want to value something, the present value, it based on what are the cash flow that you expect to get in the future, right? So what cash flow that you can expect from the stock investment is the dividend. So the first models that we will use is the dividend model. Basically, there are 3 different type of dividend models. The basic one, I think they have more complex stock valuation model, but we just learned the basic one. The first one is a zero growth. The second one is a constant growth dividend model, and then the last one is the variable growth. Yeah. And then the second models that we want to learn is the free cash flow model. So we want to value the company as a whole, and after that take out the value of debt, take out the value of preferred stock, and what left is the value of common stock. So the final one are the models. That's just the theory, not the calculation one. Okay, let's start. You see, dividend are the expected cash flow from stock investment. Then we can find the present value of the future dividend. Remember, since the company the stock has no maturity, not like bond, so what formula we can use is the perpetuity. You see, because stock has no maturity. So the price of the stock, value of the common stock today, P0, will be based on the future dividend, D1, D2 until infinity. And then the required return, how much the shareholders want. And then we get the value of the common stock. So remember, there are three different models for the dividend models. The first one is the zero growth model. So the zero growth, we assume that dividend will be constant. Dividend will be the same all the time. No growth on the dividend. So then we can use the concept of the perpetuity annuity, right? The perpetuity formula, where we assume that the cash is equal all the time, divided by interest rate. In this case, since the dividend is fixed all the time, so we can simply take the PMT divided by I. So D1 divided by R, or the dividend divided by required return. Like in this case, Denham Company, an established textile manufacturer, is expected to remain constant. The dividend is expected to remain constant at $3 forever. What is the value of the Denham stock when the required return is 15%, right? Yeah. So we normally use this model for preferred stock because the preferred stock has no growth on the dividend, right? Yeah. So dividend divided by required return. So $20, very straightforward. It's like perpetuity formula. The price means the present value. We want to know the value today. The second model is a constant growth model. Here we expect that the dividend will grow. However, the growth rate is constant. It's just one growth rate. Yeah. So every year the growth rate will, the dividend will grow. And then again, you discount with the required return. Remember, the future dividend is counted by the required return. So you can simplify the formula. So in this case, the formula is the price of the stock equal to the D1. Yeah. You see, now you have to differentiate between D0 and D1. D0 means the current dividend or the recently paid dividend. D1 is the future dividend. How do you get the D1? D0 multiply with I plus G. Then you get the D1. Divide by required return minus growth. This is the simplified version of the top or the above formula, right? It's been simplified by Gordon. Yeah, so that we call it as a Gordon model. Yeah, it's still like the perpetuity formula. It's just we minus the growth rate and the dividend should be the D1, not D0 anymore. Okay. In question, sometimes the growth rate is given to you, sometimes it is not. If it is not given to you, like in this case, you have to first calculate the growth rate. Like in this case, right? Yeah. We have the past 6 years dividend, 2007 until 2012. In order to find the growth rate, we can use the growth rate formula in the time value of money, like in this case. Take the first dividend and put minus as a PV, -1. $1 become -1 and present value. Future value is the last or the most recent dividend, $1.40. N equal to 5. You see, although we have 6 years here, why n equal to 5? Because we start with 0. 2007, 0. 2008, 1. 2009, 2. 10, 3. 11, 4. And 12, 5. N equal to 5. And then you press I. You get 6.96% or close to 7%. So then we can know the growth rate is 7%. Okay, any question? Remember, this is the formula. We need to have D1, we need R, and then we need to know G. So the first step is to learn on how to calculate G. Yeah. So as you can see, we know that the growth rate is 7%. Or 0.0696 or 6.96%. And the second step is to find D1. Remember, we need to find D1, right? Yeah. D1 divided by R minus G. D1 is you have to take the last year dividend, because at the end of year 2012 means the beginning of 2013. So D0 is 1.4 multiply with 1 plus G. And then you get the dividend in end of year 1. So $1.50. So we assume that the required return is the same. How do we find the price of this stock? $1.50 is the D1 divided by R is 15% minus growth rate 7%, and then the company should sell the stock at $18.75 in this case. This is how we calculate the constant growth model. Okay, before we continue, please ask question, because if you don't understand this, you cannot understand the next one. Any question? Or everything clear?
Doctor, may I know how to calculate the RS?
How to calculate I?
That one, the RS.
This one. I. Or
Yeah.
RS. RS is given. Like in this case, we assume that it's the same, 15%. So the required return, we assume 15%. Yeah. So for constant growth also, we assume 15%. Is it okay?
Right.
Thank you.
Yes.
Any other question? Class, clear or not clear? Okay or not okay? If not okay, please ask question. Everyone okay?
Doctor.
Huh?
For the slide 60.
60.
That is the formula to find growth rate, right?
The growth rate. Yeah.
Also, why in the formula it said G and not R?
In the formula R. No, because this I took from the what we call? From the time value of money, right? So R can be, you want to find return, or you can use also to find growth, because you have to put that on the right context. Because sometimes you may use the same right formula, but wrong context, you get wrong answer. For example, like suddenly you use this 7% as a required return, right?
Okay.
So your answer is wrong already, because we want to find the growth rate, not the required return here. Okay? Okay, thank you for your question. Any other question? Very challenging for me too to conduct class during Ramadan. Right? I start to feel thirsty. Yeah. Okay, now we move to the variable growth model. Yeah, the third model. Remember the dividend model, we have the zero growth, constant growth. Zero growth when the dividend is fixed all the time. Constant growth, there is a growth, but G is only 1, the constant rate. But now the growth rate will be multiple, right? Yeah. So there's step 1, step 2, step 3, step 4 to calculate. Yeah. So we take the example here. the most recent annual dividend payment, 2015. So mean 2015 is the end of 2015 mean time 0. End of 2015, right? Yeah. Of Warren Industries, a rapidly growing board manufacturer was $1.50 per share. So that's D0. The firm financial manager expect that the dividend will increase at 10% annual rate. G1, the first growth rate. Remember, this is variable growth model. The growth rate are multiple over the next 3 years. Because time 0, 2015, time 1, 2016, time 2, 2017, time 3, 2018. So at the end of year 3, at the end of 2018, the firm mature product line is expected to result in a slowing of the dividend growth and that will become 5%. So the first growth is G1, 10%. The second growth is 5% for the foreseeable future. And the firm required return is 15%. Yeah, still same. And then this is the first and the second step. And then there's a third one. And then there's a fourth one. So I just want to summarize all the steps here in this timeline. Right? Okay. Remember, we are at time 0, 2015. The most recent dividend. What is the most recent dividend class? D0. Now I want to ask you a question. What is the D0 here?
1.5.
Yeah, $1.50. Thank you. Amazing. And then we need to find the dividend in 2016, 2017, and 2018. How do we do that? Because remember, the first growth rate is 10%, right? For the first 3 years. So we have to use this. D0 is $1.50. D1, $1.65. Because 1.5, right? The growth rate. The second year, growth rate 10%, but to the power of 2, $1.82. D3, $1.50 to the power of 3, 10% increase or growth rate. So we get 1.65, 1.82, and $2. Yeah. Okay, how do we get all this figure? 165, 182, and $2. You see? 165, 182, and $2. These are the expected dividend for 2016, 17, and 18 because the growth rate is 10%. And then the D0 is $1.50. Yeah. Okay, remember the question say that from 2018 onward, the growth rate will be constant at 5%. Yeah. Once they say constant growth rate, we can use, you see, the bottom right formula, the constant growth formula. P0 equal to D1 divided by required return minus G. We know the required return is 15%. We know the growth rate is 5% from 2018 onward, right? Yeah. Because it will grow at a constant rate, we can use this formula. So P0 mean price at end of 2018. Yeah. Although we say it's a P0 because the rate will be constant from 2018 onward. From that, we can use a constant growth formula. But what is D1? Yeah. In this case, D0 is $2. How do we get D1 here? Right? Yeah. $2 times 1.05. So you get $2.10. Although I put D4, which is the dividend in year 4, but it's actually D1 here, right? This is how I get $2.10, if you can see. $2.10 divided by required return is 15% minus 5% growth rate. So you get $21. So the price at the end of the 2018 is $21. Yeah. Okay, question. We haven't actually got the value of the stock yet, right? Because like in this case, after you know all the cash flow, you know that 2016 you're gonna get 1.65. Okay, discount. What is the discount rate? 15%, mentioned in the question. $1.65 in 2016, value today is $1.44. 182, the value today is 138. $2, the value today is 132. The $21 value is $13.82. And then one asks, why when you discount $21, you discount with 3 years? Yeah, of course, because this is at the end of year 2018, the stock price. And then you total all the present value and you get the value of the stock the company should sell is $17.96. So this if you use manually. But if you want to use financial calculator, this is the way. Time 0 equal to 0, cash flow 0. Cash flow 1, $1.65. Cash flow 2, $1.82. Cash flow 3, you have 2 cash flows. One is the dividend, one is the value of the stock onwards. So cash flow 3 equal to 23. I equal to 15 and you calculate at NPV, you get 17.93 cents, $17.93. Yeah. So slightly smaller because of the rounding errors. Okay, that's the variable growth model. Any question? Because if you don't understand variable growth models, you cannot understand the next presentation. The free cash flow models. Please ask question if you don't understand. Okay?
Doctor,
yes.
sorry, for this one, so we don't include the dividend payment for like 2015 itself?
No,
the 1.5?
because that's already paid, right? Yeah.
Okay, thank you.
Thank you, Shazrin. That's already paid. You exclude. You just want to know what is the value when you want to sell the stock now, right? Because whoever buy the stock now, they won't get the dividend in 2015. They will get the dividend only 2016 onward. Yeah. Because the company already paid the 2015 dividend. Whoever just buy the stock at $17.96 will not get the dividend in 2015. Okay, any other questions? Okay or not okay? Class?
Okay, doctor.
Okay. Thank you, Cheng Lizan. Can we continue?
Yes.
Easy, right? Because after you understand the concept of time value of money, this will be easy for you. So that's dividend model. How do we value the stock based on the different models? Now, free cash flow valuation model. Just now, we just calculate the single value of stock. In this case, we will calculate the value of the whole company, the value of the entire company. What's meant by the value of the entire company? Is the asset of the firms, right? After you know the value of the entire company, the total asset, remember asset equal to liability and equity. But you just want to know the equity. But equity has two, the preferred stock and the common stock. You just want to know the value of the common stock. So what you need to do? First, you calculate the value of the entire company. How do we value the entire company? It's based on the expected future cash flow that you will get from your operation, right? So then you bring the value to it. So the value of the entire company, VC, but you don't want to know the value of the entire company. You just want to know the VS, which is the value of the common stock. So the total asset minus all the debt minus the preferred stock, the VP. And then what left is the value of the common stock. That's what you want to find. Okay. Like in this case, Dewhurst Incorporation wishes to value the stock using the free cash flow model. As you can see, we assume that 2015 is the year zero. In 2016, the company expects to receive cash of 400,000, followed by 450 in 2017, 2018, 2019, and 2020. These are the expected future cash flow of the company. And you want to know the value today at the 2015. Yeah. So the growth rate. Remember, the company has no maturity, right? After 2020, so they assume that the cash flow will grow at a 3% constant. And then the required return or the cost of capital is 9%. When you want to discount the future cash flow, you use 9%. The value of the debt is 3.1 million. The value of the preferred stock is 800,000. The number of shares is 300,000. So this is basically the cash flow. 2016, 400k. 2017, 450. 2018, 520. 2019, 460. 2020, 600,000. But the company will not stop there. From 2020 onward, the company will grow at a constant rate at 3%. So, you need to find the value of the company in 2020. Like the previous case, right? Use the constant growth model. So, how do we do that? You see, we use this formula. The 600,000, the last cash flow will become D0. Then we have to calculate D1. How do we get D1? D0 multiply with 1 plus G. So 600,000 multiply with 1 plus 3%, 0.3. Divide by what is the required return? Remember the cost of capital just now in the question? 9%, right? And what is the growth rate? 3%. So you get the value of the entire company in the 2020 is 10.3 million. So remember now in 2020 the company have two cash flow. One, the normal cash flow 600,000. The second one is the value of the company onwards, right? 10.3 million. So the step one is to find the value of the entire company for the future cash flow from 2020 onward, which is the value of the company in 2020. And after that, you total the cash flow in 2020 become 10.9 million. Then you can get the value of the company. What you need to do, you need to discount because this is the future cash flow. Bring all the future cash flow to time 0. So you can also use financial calculator. Cash flow 0 equal to 0 followed by cash flow 1, 2, 3, 4 and 5. Remember, in 2020 you have two cash flow. The normal cash flow and the expected value of the company, 10.3 million. So your cash flow file will be 10.9 million. Required return or interest rate is 9%. NPV is 8.628 million. Slightly different because of the rounding errors. No problem. Either one will get full mark if you answer this way. Right? So what is 8.6 million plus? What is 8,628,234 mean?
The total present value.
The value of the whole company or the value of the entire company. But here we want to know the value of the stock only, right? So remember the value of the entire company is this 8.628 million. But the value of debt and preferred stock we have to take out. 8.626 million is the value of the entire company. We minus the value of that. We minus the value of the preferred stock. What left is value of the common stock, 4.726 million. That's the value of the total common stock. Now we want to know the value of a single stock. That 4.726 million divided by 300,000. So the value of one single stock should be $15.76. So that's basically how do we use the free cash flow valuation model. Class, any question? Everyone okay?
Yes.
Yeah, thank you, Chong. How about the rest? First, in this case, we find the value of the whole company. We use the mixed stream methods. And after that, we minus the value of that, we minus the value of the preferred stock, we get the value of the total common stock. And after that, in order to know one single value of common stock, we divide by the shares outstanding. Yeah. Then we get, in this case, $15.76. Okay, class, any question? Okay, everyone?
Okay.
Okay. Thank you. So, the last one, other models. This is no calculation, the simple one. Sometimes you can also use the book value per share. What you need to do, go to the accounting report and then get the total equity value, divide by the number of shares outstanding, and then you get the value, book value per share. So this is lack of sophistication and can be criticized a lot. First, because it ignores the firm expected earning. It's just based on the value, right? And then no relationship between the company and the market because we simply look at the accounting value. That's the book value. Liquidation value per share is more realistic. What's mean by liquidation value? You assume that if you liquidate all your asset and then you pay your debt, you pay your equity, right? Although it's more realistic because we take the market value of the asset, however, it still fails to consider the earning power of those assets, the time value of money concept. So we don't estimate the future value. It's just based on the accounting record. And then another one is the price earning multiple approach. It's a popular technique because simple, right? And then intuitive. First, get the firm earning per share if you want to decide on the price. Second one, take the price earning ratio for the industry. Like in this case, if the company expect to earn $2.60 and then the industry PE ratio is 7, so the stock price can be sold at $18.20. So this is basically how you estimate the stock price or stock value using the price earning multiple. So decision making and stock value. Valuation equation measure the stock value at a point in time based on the expected return and the risk. Any decision of the firm financial manager that affect this variable can cause the value of the firm to change is shown the figure below. Remember, who will decide on the dividend, the growth rate, the required return? Because this all will lead to the price. You see that if you wrongly estimate the dividend or the growth rate, it can result in a very big difference. Like the first one. First, you estimate the dividend is $2, second $2.50, and the third one $3. So you see that huge difference between the different assumption. Even worse for the second one, when the growth rate are expected to be wrong estimation, right? So then you cannot get the right value of the stock based on the wrong estimation. So before we end, let's try this exercise. Merdeka Company recently paid a dividend of $1.70 per share. Is currently expected to grow at a constant rate of 5%. Has required return of 11. And Merdeka Company has been approached to buy a new company. Merdeka Company estimate if it is buy the company, its constant growth rate would increase to 6.5%, but the firm would also be riskier. Therefore, increasing the required return of the company to 12%. Should Merdeka Company go ahead with the purchase of the new company? Yeah. So in this case, should the Merdeka Company purchase or not purchase the new company? Now you can calculate the value of the company using which formula or which models that you can use based on the current information.
Doctor, is it use the variable group model?
Variable group model. How many growth rate do you have here?
5%.
For variable growth model, how many growth rate that you have? 5% and
6.5%.
6.5%. Yeah. But is it the same thing or different scenario? Because there are two different scenario, right? Yeah.
Oh.
One is the current value. Another one, if you make the changes, your rate will change and your required return will also change. So what you should do? Should you actually go ahead with the new change or we just remain? Remember, the decision should increase the firm value. Should actually reach the highest possible stock price, right? So the first or the second one is better for the company. To remain as it is or to actually buy a new company that will change the risk but will and also increase the required return. So what the company should do? Should they ignore the opportunity or should they buy the new company? What is your answer? Class, anyone? Buy the company. $1.5. What is 1.5? Buy the company. Yeah, how do we decide? You have to compare between the first and the second one. Yeah, Chong.
Doctor, is it the dividend for per share is also same for the buy a new company? Also the RM1 1.70.
Yeah, this is the recent dividend, right? So the dividend is remain the same. So it's just like now whether you do nothing or you buy the company. So then you have to compare. So what is the price, the stock value before they buy, and what is the stock value if they buy? Lee Chin Wee and Agnita, because you suggest that the company to buy. I don't understand. Tan Sik Tik. What's mean by 1.5? Yeah. Before 29.75 and after? After 32 and 92. So then the decision should buy the company. Okay, let's see. Thank you everyone for responding. Yeah, this is the answer, right? Because in this case, you actually have to, based on the available information, we can use the constant growth rate or Gordon model, constant growth dividend model, where we assume that the rate is constant, right? The first one, the required return is 11%, and then the growth rate is 5%. However, if the company decide to buy, the risk will increase. So therefore, the required return will increase from 11 to 12. At the same time, the growth rate will also increase, right? Yeah, because that probably a good investment. Yeah, but risk will increase because you buy a new company. So the increase in the risk being compensated by the increase in the growth rate. So the stock value increase when the company decide to buy. So therefore, the decision, you should buy the company, because by buying the new company, you will increase the share price by 3 ringgit and 17 cents. So you should do that because it's increased the value of the company. Yeah. Okay, is it okay? Any question?
Doctor,
Yes.
why the price need to thumb with the 1.05 for the first one, and then also need to thumb with the 1.065 for the second one. But at the slide before, the formula didn't thumb with anything.
That's why I told you, Chong Lizin, you have to differentiate between D0 and D1, right? Yeah. Because if, like in this case, recently paid dividend is 1.7, mean D0. But the formula for constant growth model is D1. Yeah.
Oh,
So
okay.
yeah, that's why students always get confused in exam. Yeah. Thank you for your question, because they always, because even some student, we already give you D1, they still multiply with 1 plus G, right? Because if I give you D1, mean you don't have to multiply with 1 plus G, right? Because if I say that the future dividend is expected to be 1.7, then you don't have to multiply with 1 plus G. But in this case, because it's the recently paid dividend, right? Yeah. You have to read the information. Yeah.
Also,
Yes?
doctor, expected dividend is D1 lah.
Yes, expected dividend is D1. D0 is dividend that's already paid. Yeah. D1 is the future dividend. If the information is D0, you have to convert it to D1. Yeah. This is for the constant growth and the variable growth, right? Because the dividend will grow. But for zero growth, yeah, we don't have to convert anything because the dividend will be the same all the time. Okay, thank you for your feedback. Any question? Other question? So assume that everything okay. So let's conclude. So for today, as you can see, today is another topic on the financing decision. We learn on how to value the stock, the equity, right? We first talk about the difference between debt and equity. So the second one, we talk about ordinary shares or common stock. What are the features and the items normally being used in the financial statement of the company? And after that, we talk about preferred stock or preference share. What's the difference between common stock and the preferred stock? Preferred stock is actually hybrid securities. And after that, we talk about when the company want to start the business and they need capital, they first normally start with the venture capital, because people don't want to invest in that high risk investment. Only the risk takers, investor will invest as a venture capitalist. So once the company a bit stable and need more capital, they can go public. So we have discussed about different features as well as what you call items when the company decide to go public, especially the role of the investment bank to underwrite the stock issuance. And the last part of the discussion was on how do we value the stock. So mainly, we value the stock based on the expected future cash flow. The first model is the dividend model. This is the only cash flow we can expect from the stock investment. So we learn about the zero growth, constant growth, and variable growth. And after that, we talk about the free cash flow model. We first value the whole company. We minus the debt, minus the preferred stock, and what left is the common stock. And then we divide by the number of the shares outstanding, and then we get the single value of the stock. And the last one, we talk also about other models that we can use to value the stock. And remember, deciding on the D, R, G, all very difficult, right? So that the company have to be very careful. Otherwise, the estimation of the price will be wrong. Yeah. So before we end, any question? Remember, next week is your midterm, and today is the my last lecture for this semester on the financial management. So I wish you all the best in your midterm test and the rest of the semester. And then probably half of you will still be with me in the tutorial. And today, this week, we're gonna discuss on the bond valuation tutorial question. I think thank you everyone for joining the session, and thank you also for being with me for the last 7 weeks for the lecture. And then wish you all the best. I hope all of you will pass, and then we can meet at other subject. Okay, thank you. Iqmal, question.
Hello, Doctor.
Hello.
Never mind, you go first.
Okay. May I know what for our midterm test is MCQ or subjective?
MCQ.
Oh. How many MCQ?
I haven't decided on the numbers yet. Probably I'll let you know by end of this week or next week.
Oh, okay.
Okay.
May I know is it like last semester we cannot go back the last question?
No, cannot go back. Yeah, same.
Oh, is it also like last semester randomly set the question, so everyone's question are different?
Yeah, most likely. I haven't finalized the question yet. So I probably will have a look at this week. I mean the set of the question and what are the questions that I want to ask you.
Okay, then, thank you, Doctor.
Most likely will be the same like the format, like the first semester. Not the question, but probably the format.
Okay, thank you, Doctor.
Thank you. Other question, Hikmah?
Doctor, I just want to ask again about the free cash flow. The VC, right? The market value of the entire
company.
Is it given or we must?
No, of course not given. Iqmal, all this why we calculated the VC, right? All this. You see, 8,626,426 is the VC. Yeah, it's not given. You have to calculate the VC, all right? And then you have to minus. Yeah, all this, right? All the VC. The NPV is the VC. Yeah. So this is given 400,000, 450, 520, 560, 600,000. But you have to calculate 10.3 million. And then you put 9%, and then you get the value of the VC. So then you use the VC, you minus, like in this case. VC is not given. Yeah, you have to calculate. VD and VP given normally. Yes. Okay, Hikmah?
Okay. Thank you, Doctor.
Okay.
I was confused just now.
Any other question? Yeah. Okay, thank you again, everyone. Assalamualaikum and good afternoon. Wish you again at other course. Bye-bye.
Thank you, Doctor.
Thank you, Doctor.